Well, there's been a lot of talk lately about China buying record amounts of silver, building a gold network, and maybe setting up for a completely different monetary system. So in this video, we're going to separate the serious part from the sensational part, and you're going to walk away with a much clearer view of what is actually happening, what is possible, and what people are probably exaggerating. Today is Saturday, May 2nd, New York time, and before we go further, comment what day and date you're watching from because this story is moving fast and I want to know where you're seeing it from. Also, if you value my content and want to support the work, subscribe and comment John AG Best. That lets me know you want the real breakdown, not the recycled copycat version. So let's start with the big claim. China is not just buying metal because prices are going up. China may be using gold and silver like financial infrastructure. That's a very different thing. In the West, most people treat silver like a trade. They watch the chart, they cheer the breakout, they panic on the pullback, and then they ask whether $300 is next. China appears to be looking at the same market through a much longer lens. And that's where this gets interesting. Because if China is buying silver after spending decades building a gold foundation, then this is not only a silver story, it is a settlement story. It is a currency story. And maybe, just maybe, it is a warning that the old paper system is under more pressure than people want to admit. But we have to be careful. Serious facts can turn into ridiculous conclusions very quickly. So first, let's look at the gold foundation. The idea is that Chinese policymakers never fully accepted the Western view that paper money, central bank promises, and floating currencies are enough forever. Whether you agree with that view or not, the behavior is what matters. China controlled bullion tightly for years, pushed domestic gold market development, encouraged physical ownership, and kept building official reserves even after prices became expensive. Based on recently published numbers, China's central bank added gold again in March, extending a long buying streak and lifting reported holdings to a little over 2,300 tons. Gold now makes up just under a tenth of China's official reserves. That is not some random hobby trade. That is a reserve policy. There is also a historical reason this argument keeps attracting attention. China did not build its modern financial system inside the same cultural assumptions as Wall Street. The country had long memories of hard assets, trade settlement, and state control over strategic materials. So when Western markets spent decades treating gold like an outdated insurance policy, China had an incentive to treat it like a silent reserve layer. Again, that does not prove every extreme estimate, but it helps explain why a slow official buying program can be more important than the monthly tonnage makes it look. Now, people often jump from that fact to a much bigger claim. They say, well, if official reserves are that large, the hidden reserves must be enormous. Maybe China has tens of thousands of tons sitting somewhere off the books. Is that possible? Sure. Is it proven? No. And that distinction matters. Think of it like hearing footsteps upstairs. You know someone is moving. You know something is happening, but you don't know whether it's one person carrying a bag or 10 people moving furniture. The evidence shows China values gold deeply. The evidence does not let us count every hidden bar with confidence. Still, the direction is hard to ignore. China became a massive gold producer. Its domestic market became one of the most important physical gold markets in the world. And Chinese buyers have been shifting away from jewelry alone and toward investment forms like bars, coins, and gold funds. In the latest quarterly demand numbers, global bar and coin demand reached one of the strongest levels on record, with Asian investors playing a major role. Total gold demand, including private over-the-counter activity, was a little higher than last year, while the value of that demand surged to a record near $200 billion because prices were so high. That tells us something very important. When prices rise, jewelry buyers often back away. Investors do the opposite if they think the currency system is weakening. They buy because the price is high, not despite it. That is the psychology of fear, protection, and distrust. And now that psychology is spilling into silver. China's silver imports in March were not normal. According to recent customs-based market reports, China brought in roughly 800 plus tons of silver in 1 month, far above its usual March pace and almost 3 times the long-term seasonal average. That is a real data point. It is not just a rumor floating around social media. But here is the mistake people make. They see a record silver import number and instantly they say, that's it, the squeeze is here, the system is finished, silver is going to $300 next week. Okay, slow down. A record import month is a signal. It is not a prophecy. It tells us China needed a lot of silver. It tells us physical metal moved toward China. It tells us manufacturers, investors, or both were willing to source metal aggressively. But it does not automatically tell us the global market has broken. There is a difference between tight and broken. There is a difference between bullish and guaranteed. This is also why lower prices during a buying wave are not automatically a contradiction. People sometimes assume strong imports must push spot prices higher immediately, but paper selling, hedging, inventory movement, and temporary manufacturer timing can all hide the pressure for a while. Physical demand can build underneath the market before the chart admits it. That's why I care less about one daily candle, and more about whether metal keeps migrating toward the same buyers month after month. And silver is complicated because it has two personalities. One side is monetary. People buy it when they don't trust paper money. They buy it when gold feels too expensive. They buy it when they think governments are printing, borrowing, inflating, or losing discipline. That side can move extremely fast. The other side is industrial. Silver goes into solar panels, electronics, vehicles, electrical systems, medical uses, and all kinds of small components that most people never think about. That side is real, but it is also price sensitive. When silver gets too expensive, manufacturers start trying to use less of it. And that is the counterpoint everybody needs to hear. The solar industry is not a silver fan club. It is a margin business. If silver prices jump too far, producers look for thinner lines, lower loadings, substitution, and new designs. Recent market reporting has already shown the solar sector accelerating efforts to reduce silver use after prices exploded. That does not destroy the bull case, but it does mean industrial demand is not a straight road upward forever. So if someone tells you silver can only rise because solar demand can only grow, be careful. Solar installations can rise while silver per panel falls. Both things can be true at the same time. Now, does that mean silver is weak? No, not even close. The real silver bull case is supply. Silver mine supply is stubborn because a lot of silver comes as a byproduct from mines focused on other metals. So even when silver prices rise, the supply response is slow. You don't just press a button and create a new silver mine. It takes permits, capital, labor, equipment, energy, and years of patience. That is why deficits matter. Latest industry forecasts still point to another annual silver market deficit, even with demand shifting around. One recent outlook expects physical investment demand to rise sharply, while total supply increases only modestly, leaving the market short for a sixth straight year. So this is the setup. Investment demand is waking up. Industrial demand is changing, not disappearing. Supply is slow. Above-ground inventories have been drawn down over multiple years, and now China shows up with a massive import month. That's not nothing. But we still need to ask the most important question. Why would China want so much silver now? There are probably two answers. First, industrial users may have been securing metal before policy changes, export shifts, or supply chain disruptions made things harder. When manufacturers see uncertainty ahead, they don't wait until the shelves are empty. They pull forward demand. They stock up. They protect production schedules. Second, Chinese investors may be moving into silver because gold has become expensive. This is a common pattern. Gold moves first. Silver looks cheap by comparison. Retail buyers decide silver gives them more ounces, more upside, and more excitement. Then silver catches a bid, but here is where it gets bigger. China has also been expanding gold market plumbing. Last year, the Shanghai Gold Exchange officially launched its first offshore gold delivery vault in Hong Kong and added contracts connected to delivery there. That matters because monetary change does not always begin with a speech. It often begins with storage, settlement, contracts, and delivery points. That's the quiet part of the story. A vault is boring until it isn't. A delivery contract is boring until a trade partner wants metal instead of another paper claim. A currency settlement mechanism is boring until sanctions, tariffs, or debt fears make everyone rethink what safety means. This is why I don't view China's silver buying in isolation. I view it as one tile in a much larger mosaic. Gold reserves, public gold ownership, offshore vaulting, Yuan settlement ambitions, silver imports, industrial stockpiling, investor demand, global debt, trade tension. Put those tiles together and you get a picture that looks very different from the old world. Now, does this mean China is about to announce a fully gold-backed yuan? Probably not. That's another leap people make. They take real infrastructure and turn it into a dramatic overnight reset. But China has capital controls. The yuan is not freely open like the dollar. China has property market stress, debt issues, demographics pressure, and plenty of reasons not to promise instant convertibility into gold. So the smarter version is more gradual. China does not need to replace the dollar tomorrow. It only needs to make the yuan more useful for certain trade flows. It only needs to give partners another way to settle. It only needs enough physical metal credibility that exporters, energy producers, and commodity players say, okay, this system is not just paper. That is how alternative systems grow. Slowly at first, then suddenly enough people notice. And this is where silver could become very important. Gold is the reserve signal. Silver is the stress signal. Gold tells you what central banks and long-term savers are thinking. Silver tells you what industry, retail investors, and physical supply chains are feeling. When both start moving together, especially in Asia, you pay attention. One more thing matters here. Silver is small compared with the markets that are starting to notice it. A tiny rotation from cash, bonds, equities, or gold-linked savings can overwhelm normal silver investment flows. That does not mean everyone rushes in at once. It means the market does not need a huge percentage shift to feel a huge price effect. In a small market, marginal demand is the whole story. And when that marginal demand comes from a country already dominant in manufacturing, refining, and consumer metals demand, the signal becomes harder to dismiss. It may not be the final alarm bell, but it is definitely not background noise. That is why this story deserves patience, not panic, and close attention instead of blind excitement from investors everywhere today. Now about the $300 silver target. Can silver get there one day? Yes, under the right conditions. Would that require a normal market? No. For silver to move that far, you would probably need a major monetary panic, a serious physical shortage, a huge investment wave, and a gold price much higher than today's already elevated level. You would need people to stop asking, what is silver worth, and start asking, what is paper money worth? That's a different environment. So I don't like treating $300 as a casual prediction. It is more like a crisis scenario. Possible, but not something you should build your entire plan around as if it is guaranteed. If you're successful, share your success story in the comments so others can stay motivated. So what should investors actually watch? Watch whether Chinese silver imports stay elevated or fall back after the March surge. 1 month can be stockpiling, several months can become a pattern. Watch premiums. If physical silver trades tighter in Asia than in Western paper markets, that tells you the stress is geographic and physical. Watch gold. If gold keeps attracting central bank and investor demand, silver has a stronger monetary backdrop. Watch solar thrifting. If manufacturers reduce silver use faster than expected, that can cool the industrial side. And watch the vaults. Because if more metal trading starts moving through Asian settlement systems, the market's center of gravity may be shifting. So, putting this all together, China is not simply buying silver because it likes shiny things. China is operating in a world where governments are deeply indebted, trade relationships are becoming more political, and reserves are no longer just about earning interest. They are about access, control, and independence. That is the real story. Maybe the hidden gold claims are too high. Maybe the $300 silver calls are too early. Maybe some of the hype burns off and silver pulls back again. Fine, that can all happen. But the underlying shift is still real. Physical metal is being taken more seriously. Asian demand is becoming more important. Silver supply is not flexible. Gold infrastructure is expanding outside the old channels. And investors are starting to understand that a metal shortage does not always announce itself with one giant explosion. Sometimes it shows up as higher imports, tighter inventories, stronger premiums, and quiet delivery systems that keep growing in the background. That's what I'm watching. Not the loudest prediction, the plumbing. Because in markets, the plumbing usually moves before the headline. And by the time the headline finally arrives, the best part of the move may already be behind us. As always, this is my educational analysis and not financial advice. Don't buy or sell anything just because a story sounds powerful. Precious metals can be extremely volatile, and your decisions should match your own risk tolerance, your own time horizon, and your own financial situation.